Okay, welcome everyone. We'll start our lesson 3. Today lesson will go through like LO3, be able to interpret financial statement and make uh, justified recommendation. On basis of this, we can recommend either to invest in the certain companies or not, and they will go through the financial ratios. My name is Anjum Satha and my email address anjum@ukversity.co.uk. If you have any question, please, if you're listening this recording, drop me email and I'll try my best to get back to you as soon as possible. So we'll go through previous lessons. We discussed about sole trader, partnership, limited company, charities. We discuss IES, International Accounting Standard. We discuss about financial reporting standard. We discuss how many types of financial statement we prepare. Do we remember anything else we learn?
Yeah, we do.
What else do we?
In 4 types of financial state. There's one of them is a profit and loss account.
Yes, we learn about statement of comprehensive income,
Comprehensive income, yeah.
position, statement of change in equities, statement of
financial position.
So all these we discussed in the previous lessons. That was the key, the topics we covered, and we discussed about limited companies and financial statements. Yes. So during our last lesson, so today lesson is indicative content, what we're supposed to be learned today, calculation and the interpretation
of ratio analysis.
We'll go through the liquidity ratio. Do we know what is meant by liquidity?
Yeah, liquidity, I know, what I cannot explain it.
Okay, liquidity mean is near to cash.
Yeah.
All you
easy to transfer to cash.
Yes, it can convert into the cash itself, and any other things such as inventory, such as the receivable, we can convert them into cash.
Yeah.
So that is called liquidity ratio, which is based off current asset divided by current liability.
Yeah.
Working capital cycle is meant by how long will takes inventory turnover days plus trade receivable days minus trade payable days. That cover one cycle, one capital cycle, or we call working capital cycle.
That means the current asset minus current liabilities.
No, liquidity ratios current asset divided by current liabilities.
And working capital equal to current asset minus current liability.
It's a trade receivable in days plus inventory turnover in days minus trade payable in days. How long will, because always you try to get the cash quicker from the customer and try to pay later your suppliers.
Okay.
So this is show the working capital cycle. And we'll go through efficiency ratios, how well we utilize our resources. We'll go through the different resource utilization ratios as well. We'll go through interpretation of accounting ratios, how we can compare with the industries and averages, on what basis we draw the recommendation to invest or not, the usefulness of ratios and the performance in business. We'll discuss some standard these are in our today lesson. Really, that will be our discussion. Today lesson in our learning outcome, our assessment criteria we have. Learning outcome is a 3, but assessment criteria 3.1 is evaluate the accounting record. So when you say evaluate, so we need to look around in 2 years and we can evaluate what's happened. We need to make recommendation, improvement of organization, how organization can improve. We can analyze the ratios and accounting record, and we can evaluate the international differences in the financial reporting standards. So that's, all will be covered today lesson. Any question? If you have, you can ask. Okay, welcome, morning. Okay, we'll move to the next. So Financial Reporting Council has issued a number of changes. One is called micro, small, and medium and large organization. They have a different standards for it. Okay, so the Financial Reporting Council in UK, and if it will say IFRS, it become International Financial Reporting Council, yes.
Mm-hmm.
So, which is quite similar, has issued some changes, and they are largely responsible the implementation new EU accounting directive and include a new standard FRS 105. What is a 105 in is the financial reporting standard? Financial reporting standard applicable to the micro entity. Micro means small
Smaller.
organization.
Yeah.
A new section 1A, small entities, FRS 102, financial reporting applicable in UK, Republic of Ireland. If we want to further explore sections, we can as well. Other changes necessary to comply with the company law. Company law at the Company Act we have a 2006. Annual review of 101. 101 is reduce the disclosure. Yes, in
Okay.
some areas we don't need a lot of disclosures. And the main changes in the effective for the accounting period began from 1st January. Early application permitted accounting period began on or off. That's the year start. Financial reporting standard also available. Overview the financial reporting, describe the financial reporting framework. If we want to be explore further, what we can do, we can copy IFRS 102, and next to that in Google, if you write Kaplan, Kaplan is a publisher, so we
Mm-hmm.
can read full standard all these. So new requirement FRS 105 and section 102, which we'll discuss. So micro is the definition. Entity contained in a section 384 and 384B, the Company Act 2000. The qualifying condition to met the company is in a year, and it does not exceed two or more of the following criteria. Turnover should be
Got it.
632,000. Balance sheet total is mean the total worth of asset 316,000, and number of employees 10. If
Okay.
those have and that come under the micro. The reporting option FRS 105 and 1 year only, yes.
Mm-hmm.
And the section 1A of 102, which is financial reporting standard, EU adopted international financial reporting standard, and of FRS 105 section 28 transition to the financial reporting standard to the first time adoption. It contained the requirement first time include the micro entity shall not if changes the accounting they followed under the previous accounting reporting framework. They carry on the recognitions of the financial asset and the financial liability in the financial statement. Financial assets and the financial liability we need to be de-recognized under the micro entity previous accounting framework before the date of transition shall not be recognized upon adoption of new, this is FRS. So we need to be looking on the financial assets and financial liabilities in this period of time in under the micro, because do we know the what is the asset? Asset is mean anything you own it, anything
Economical.
has anything which flow the future economics benefit.
Yes.
But some asset like contingent asset or contingent liability we're not supposed to show. But if the likelihood is more than 50%, no, we need to show in our, because otherwise we're not providing true and fair information to our user. This is
Okay.
all about the standard is all these standard is still is the issues, the how we can make sure we provide the true and fair information and our user can make the right decision.
Mm-hmm.
And the audit requirement for the company, those have a turnover and more than that and 50 employees, and all the guidance is given under 102.
Okay.
Okay. So this is the basic introduction about. Then we have a user of financial statement. When interpreting the financial statement, it is important ascertain who are the user of accounts.
Hmm.
What information, like shareholders, potential investor, they are primarily concerned adequate return. Yes, they want to make sure the company's stability, because if the company is not stable, and the liquid of the business. Supplier and lender, they have a concern with the security of the debt. They want to make sure they will get the money what they give the loan. Another potential financial institution implies they are also concerned with secured jobs, professional advisors to investors, and the financial journalists. All these they need information, but they have a different purposes. Okay, so what is meant by ratios? We know the how many types of financial statement, four types of. We know what's contained in these statements, which we discussed in the previous lesson. So today we'll go through the ratios. Ratios is used simple calculation based upon the interaction in the set of data. For example, changes in the cost of sales has a directly link to the changes in the sales activity. If your sales activity increases, your cost of sales will increase as well. Changes in the sale activities also affect upon the wages, salaries, receivables, inventories. Ratios allow us to see that the interactions in the simply concise format. Ratios is a limited use on its own. If we look the before the COVID-19, maybe ratios really look good, really good. But after the COVID-19, now
Yeah.
totally different worlds. Yeah. If
Hmm.
we only relies on the ratios, maybe we invest it, yes, but is
Yeah.
totally different. So we need to be make sure we look around the current environment, what is happening as well. Okay, ratios. It can be current ratios, which is known as a liquidity ratio. So liquid ratio have two types of ratios. One is called current ratio. Other is also known as quick or asset test ratios. So when we know the current ratios, it's been current asset divided by current liability.
That is all
Now,
current asset including.
sorry?
I say all current asset is including.
Yes,
And
so
and
current, it's a
is it?
cash, it's a receivables,
Yeah.
it's a inventories and prepaid.
Hmm.
So these are all known as a current asset.
Hmm.
Always given, these are always given under the current asset section in the balance sheet.
Hmm.
And then you divide by the current liability, which is given under the current liability, like accrual, trade payables. Yes,
Yeah.
these are all given under the current liabilities. So current asset divided by current liabilities, our ratio should be 2 to 1. 2 to 1 meant by £2 worth of asset and £1 worth of liability. Then it means the company's liquid position is very strong. But it
Okay.
varies industry to industry. It's not mean every industry will be the same ratios. So we have to look around the industry average. If we'll type on Google Finance, we almost every company's ratios already given. Really, we
Yeah.
don't need to calculate, but we can calculate by using the formula. Yes, cash is also part of the current asset. Liquid is mean the cash or any asset which is near to cash, or we can convert into the cash quicker.
Yeah.
That's why we call liquid. Then we have a, sorry, I can't hear you. Okay, I'll try. Hello, can you hear me now? Hello. Okay, can you hear me all? Okay, you can confirm by chat. If you can't, speak on the mic, please. Okay, so next we have quick ratios. Great. Quick ratios, it mean sometime inventory stock people are not willing to buy quicker, and we
Yeah.
can't convert into the cash. So that's why what we can do, current asset, whatever the total asset we calculate in the first one, we minus inventories out of it, because inventory is not most liquid. So quick
Yeah.
mean most liquid divided by current liability. It's normally we say it should be 1 to 1. One
One
pound
to one.
worth
Yeah.
of asset, 1 pound worth of asset, 1 pound worth of liability.
2.1, 2.1 for the current ratio and 1.1 for the quick ratio. Yeah.
Yes, always better. But it varies industry to industries. Yes.
Yeah.
So, but is that's good, if we have that. So when we interpret, our ratios come 2.2, so we can say is very good. Yes.
Yeah.
If last year was 2.2 and this year was 1.8, so we can say is decreased. Yes. So
Yeah. It's a
liquid
decline. Financials.
drop. So it means liability increase, asset drop, and we can recognize by the figures as well, which we'll go through some question today. Interest cover ratios, and then we have a financial position ratios, which we also call gearing ratios. So interest cover mean how much interest we are paying and how much profit we have. So profit from operation, which we can find figures in the statement of comprehensive income, which we call profit and loss, divided by interest cost. Interest or finance cost at the same time. So if our profit is 10 times more than the interest figure, which is quite good, yes? So
10
if
times more. Yeah.
next year it will drop 3 times our profits, still we will be in a position to pay back our loan, our interest at least. So that's the way the interpret by various lenders, and they are really interested in these ratios, which is interest cover ratios, like banks. Okay, gearing ratio. Gearing, if you drive a car in a high gear, is a high risk. But
Hmm.
normally, that if you borrow money from the bank is a cheaper, or if you borrow money from the shareholders is expensive for the business. But the
Yeah.
shareholder technically is the owner of the business. If you don't pay them dividend, maybe still they can say, okay, no problem. They can wait for 1 year. But normally dividend, they expect more than 10%. Interest, we can borrow money from the bank, maybe 2%, less than 2% interest rate. So that's why, but we need a gearing, always good to be higher the debt and lower the equity financing for business, because the debt is a cheaper source. And if you have a debt, any interest you pay on the debt is expense for the business. And in term of, you can save on the tax as well, 30%. Now it's 19% corporation tax. But when
Debt
you
is
have,
cheaper. That means debt is cheaper than the shareholders.
yes. So the if we have a equity financing, we borrow money from the shareholder issuing share. The shareholder expect at least 10%. And second problem we have, because the share dividend we pay after the tax. So
Yeah.
dividend is not expense for the business. So still we have to pay the tax. So
Hmm.
that's why we need to look around all the reasons behind. So gearing is formula is non-current liability, mean long-term liability like a bank loan, mortgage, divided by total equity plus non-current liability. So normally we can say if is a less than 60 is a better, yes,
Sorry. How long?
less than 60 is a better. If
Less than
more than
60.
60, yes, if it's becoming higher compared to the last year, higher is mean more risky business. Business
Yeah.
is becoming more risk. Higher the gearing ratio, higher the risk.
Yeah.
Okay. Which is all we'll interpret. Then we have a profitability ratios. we have different formulas we can use for that. There are good few ratios under the profitability. Most commonly we use the gross profit divided by revenue. Revenue means sales
Mm.
times by 100. It shows how much worth of the sales, how much gross profit we generate, and how much is going toward the cost of sales. If it's dropped compared to the last year, it shows that the cost of sales went up, or we don't have a good negotiation power with the companies. Yes.
Mm.
So, or we need to find the different suppliers to reduce the cost of sales, increase our gross profit margin. Then other very important ratios we calculate is profit from operation. Profit from operation can be before tax, after tax. Yes. So let's
Yeah.
say after tax divided by revenue times by. So it shows, how much profit we have after meeting all the expenses.
Yeah.
So that is a crucial thing because you can compare with your competitors, you can compare with the industry averages, you can compare with the last year, this year. But this is not meant by the company have a strong cash position. You have a profit, maybe you have all the credit sales and you have a profit, yes?
Yeah.
So we need to be very careful to look around these. Then we have one other ratio they call return on equity. Equity means the shares. So profit after tax divided by the total worth of equity, worth of the shares we issue time. So we can find how much worth of return every share we have. Even we can calculate EPS, earning per shares as well. Yes, we can divide by the numbers. Okay, that's one other way. Then one is return on asset. How much worth of the company asset? This also shows how well you utilize your asset. Profit from operation divided by total assets. Other ratios we can profit from operation divided by how much capital implied, because equity plus non current liability, long term borrowing, we borrow money to buy the long term asset. That's why we can use this ratio to calculate return on capital employed. Any question?
No, it's fine. Thank you.
Okay, that were the profit ratios. And next ratios we have a use of resources, or we called efficiency ratios. So these ratios here in this side, all the formulas is being summarized. Inventory, turnover, cost of sales, which we can find from the balance statement of comprehensive income statement.
Just one thing. When we write assignment with this ratio analysis, we have to discuss all of them, or we have to just pick
So no,
some.
we can discuss few ratios. Like,
Yeah.
we can do two liquidity, two profitability, two use of resources, two gearing, these
Okay.
8 ratios, and we can interpret them,
Okay.
which I'll show you. I'll give you templates as well. Okay, so we can look around the cost of sale divided by inventory times by how many times inventory being converted into the finished goods in a year. That shows, yes.
Yeah.
So if 10 times, if 5 times, it's reducing, its mean becoming a problem for the business. Second ratio is inventory holding period. How long we are holding the inventory, then converting. It is a 60 days, 50 days. Higher the days is more bad for the company. Yes,
Yeah.
always good. That's why we are using just in time. You buy only inventory when you use it, when
When
you
you
need,
use.
when you need it. That's why companies taking order advance and then they manufacturing. Okay, then we have a trade receivable. Trade receivable always is debtors figures given under the current asset divided by the revenue times by 365. Yes.
Yeah.
So then we can compare with the trade payable days. So trade receivable, if the trade receivable is a 30 days and trade payable should be more than at least 50 days. So there will be a safety net. If the customer don't pay us, at least we have a 30 days worth of the cash in the business. Yes. So
Yeah.
that's why you need a good negotiation. But if it's a too long, maybe if it's a 90 days payable, like in the Tesco used to pay in 12 months or 18 months to the small farmer. That can be bad press as well. Huh? That maybe the supplier will not supply us goods. So we need to be very careful. The working capital cycle, all these ratios when you calculate inventory turnover days plus receivable turnover days minus payable, so that will give you working capital cycle. Huh? Yes,
Yeah.
one cycle. So that's we can compare year by year. So asset turnover ratio, the revenue divided by total asset. Then we have asset turnover. It can be with the net asset or with the total asset. Huh? So that's we can. And it's, so these are compare the use of resources are we also called efficiency ratio. So all these ratios in the next slides is being all explained as well. The main objective of financial statement help the user to make the decision. We can calculate the ratios, we can interpret it to make the right decision for future. Like here is you will see there all these ratios being explained, return on capital employed. You will see there, yes, profit, in all the interpretation which I explain you. Yes, current asset divided by all the formulas. So then next now we are looking, I'll show you, we're looking this company. We have two companies and we want to compare the performance. Huh? Sorry, these are old, my handouts, so just I'm using as it is. Huh?
Even
But
though,
doesn't.
if you want, we can take this company as well. Yeah. If we want, we
Oh,
can
yes,
take
yes.
this company.
You can, or we can take the real company, Tesco and Morrison or whatever. Huh? We can compare two, or we
Yes.
can compare one company 2 years. Huh?
Okay.
So let's assume here we have been given non-current asset. Yes,
Mm-hmm.
we've been given the current. If we want liquidity ratios, I can say my current asset is 7123. Yes,
Mm-hmm.
and I can divide by my current liability, which is given here. Yes, 3876. Let's do. If you do now 7123, yes, divided by 3876. Yes,
Yeah.
and we will get our, sorry, I'm not sure I've done. Yes, on this slide. This is my, if I'll take out inventory out of it, my ratios I already calculated here is coming 1.22. Yes,
Yeah.
so that's it. So if you want to do your current, you can do as well. Yes, so what you can do, you can divide it 4747, yes, divided by 3876. That's the asset test is most liquid. If you include the inventory, don't minus it, yes, then it's mean you divide with it 7123, yes.
Yeah.
So you can do, let's say 7123 divided by, yes, so divided by 3876. Huh? So that came 1.83, yes,
Yeah.
1.83. So you can compare with other company now, yes. So if I'll compare with other company, they have 2758 divided by, I'll find, and Papikas 2995, yes. So you will see there they have 092. So which was better? The first was 1.83 and the second came 0.92. Which one is a good?
Which ratio it was?
Papika and Anika, you will see here, yes. The first company, my calculation came 1.83.
Yeah, but it
Yes.
is gross profit margin or operating, or who is
No,
like
no,
that?
I'm just looking liquidity ratio, current asset divided by current
Oh,
liability.
this is the 1.83 is better.
1.8. So we can say 1.8 is a better than 0.92 because it's a less risky. They have
Yeah.
more assets compared. You will see there they have a current asset 7123. Yes, again
Yeah.
the current liability. So we can interpret this, but we can say further we need to look around industry averages as well.
Yeah.
Okay, so that's the way we can interpret these ratios and we can write in our own words.
Yes, fine.
Okay, which we'll go through, of course. Okay, so that's so am giving you the all these ratios based on, if you look now, let's say profitability of these, so you can go back to look at the profitability of this company. So Papika's, how much is profit? Like you will see their gross profit, they have 16,200. Yes, you can
16,200. Yeah.
divide it by 36,000 times by, yes, I
100.
already calculated the ratio. So here in this, yes, you will
Yeah.
see that gross profit is 45 and other is
52
52.
points. That means
So
paprika is better than.
according to this ratio, Papika is better than Anika. Then you go operating profit.
No,
This
but
is,
still we have to look at the paprika, how much paprika got interest, these kinds of things, how much debt they have. Then we can compare that this one is better
yes,
than them.
you can do all the ratios. Here we done few ratios. We pick
Yeah.
few from the profitabilities. We pick one or two from the gearing. Yes, we pick
Yeah.
all of the one or two. But you can look around full. Yes, full analysis.
Yeah. Yeah.
So no harm. So you will see there 9. So according to these two, according to this is the Papika is the better. Then
Hmm.
according to gearing, Papika is better. Yes.
Yeah.
Sorry. According to
No,
Anika is the
gearing is
better. Anika is
gearing
better.
is
That's a less
Anika is
risk.
better. 13.26.
Yes, 13.26 is a, because gear, if you drive high gear, yes, high data, high
High
risk.
risk.
So this is less risk.
Mm.
Okay. So then you look the interest cover. This is 11.6 time. Yes, this is.
Yeah.
But because this is Papika is a very risky. So if you can be at the risk high, maybe you get, in business we say higher the risk, higher the return.
Mm.
So Papika is a more risky. Maybe they can't afford it, pay you back even, because they are borrowing too much. So
Yeah.
a company performance, maybe compare the previous period performance, past performance. If we can compare, all is being, and then horizontal analysis we can use. Yes, vertical analysis we can look around we can look around industry averages. We can look around in same industry. We can
What is
look around.
horizontal analysis and vertical?
Yes, so we can do horizontal mean, with different companies in the same industries and across
Okay.
industry. So we
And
can look around.
vertical means same one industry, but the previous year and the next
Yes,
current year. Okay.
that's it. And then we have here, consider the business strategy. We need to look around the company's future plan, what they're thinking, what is the CEO's background. Yes, what
Yeah.
visions, like when think about Apple, they are going to launch a new mobile and the reviews is really good. Yeah, this
Yeah.
will, like COVID-19, Amazon's, are Bitcoins and various company cryptocurrencies, they are growing. So we need to think about which industry, what strategies or what trend is going, not just about the ratios.
Mhm.
Okay, then this is, you will see here we can look around investors or these stakeholders, what sort of information they help to determine to buy the shares or not. Yes, and other, everyone is a different purpose. So we need to decide which ratio is the best to look around if I'm investor. If I'm implied, which ratio is best for me to look around? Yes, so we can make the decision. And then based on this, we did the analysis. Gross profit per pica is a better, yes. Operating profit per pica is a better. Gearing ratio, Anika is a better. Interest cover ratios, Anika is a better. Asset test ratio, Anika is a better. As far the profitability is concerned, is a better ratios found in the Paprika. Anika's profit, which is while it's not good, Paprika are the preferably acceptable. The other ratios show the Anika is a better in term of the debt, yes, ability to pay, and while the Paprika's interest cover ratio loss worse than others, so marginally acceptable, but others two ratios dangerous level because there's a high gearing there. In conclusion, you as a yes, since our main concern is the riskiness of investment, I would advise to be invest in Anika, which is less risky.
Yeah.
Yes, because you don't. While therefore the profitability is the better in in Paprika, Anika still is a preferable because still they are earning profits, but you will earn less profit, because there's a less risk. Paprika is a more risky and less solvent and leading to the danger, being unable to cover the debt maybe. Any question?
No, it's fine.
So all this been explained here. Then we have a further reading if you want, yes. So you can copy this link and you can look around further, please. So Kaplan. Any question?
No, it's fine. Thank you.
Okay, so today lesson, guys, we covered the ratios. We discussed four types of ratios: liquidity, profitability, use of resources, and gearing ratio, or we call financial position. And these ratios, we can use it to make the financial decision, either to invest or not, and various users use these ratios for different purposes. Yes, any question?
Okay, evaluation of the international defense and financial reporting. You maybe on your lecture you were talking about this. How do I do this on?
Okay, so we discuss about IFRS.
Yeah.
Yeah, we discuss about FRS 102. Yes, you type here if you want to look around Kaplan. Yes, yes, Kaplan is a publisher. Yes, or ICW. Do we know ICW's website?
Yeah. Institute
Is
of
it?
Chartered Accountants, England and
Yeah.
Wales.
So they always publish, any new standards come. Yes. So
Yeah.
what this standard is about? Yes, you will see the version of when it's been released. Yes, release dates and what is about. Yes, 10 is the
Yeah.
financial reporting. That's these are carry on chaining is all about the layout, the asset treatments, and if you want to read the article on these ACCA, yes, and you can even read the article. Yes, this
Yeah.
is the technical articles you will see here, and technical article you can use to be for, and in our assignment we can reference as well.
Okay.
Yes, so you will see here this is the gaps reports about the technical fact sheets, yes, about the financial reporting standard. This been released and we can download and we can read it in our full detail. Yes, that's all, because this is all about the micro company and the treatment of.
That means we have to make comparison how IAS standard regarding the 102 and how the
No,
FRS.
but just little explain what is 102 is all about.
Oh, just what is 102? Just
Yes, yes, we don't need a lot, because
okay.
otherwise.
According to IAS, according to
Yes,
gap.
whatever according to assignment brief, so which will go through. So
Okay.
like here, this is 102 is about this micro companies, yes, and the treatment, yes. You will see there 102, 105, yes, is all been explained here. But it's a lot of
Okay.
explanation. We don't need a lot, yes. We just say
Okay.
what it's about.
Okay.
Okay. Otherwise,
Thank you.
there can be each elements of treatment, joint ventures, mergers, consolidations, and all.
Okay.
No, okay. If you have any question, so please you can ask. And in the next lesson, what we'll go through assignment. Actually, itself. Okay, so next lesson we'll go through assignment. So until that point, please go through these lessons. Yes.
Yeah.
And try to attend next lesson, so I'll guide you how we can reference, how we can structure, how we can address all the learning outcomes. That's all today, and hope so I'll speak to you all during our next lesson. Have a nice weekend
And
and
you take care.
a nice
Bye bye.
time. Thank you. Bye bye.